Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Our analysts weigh in today on the recent unemployment data and what it may mean for the stock market. We'll be hearing from Steve Reitmeister, our editor-at-large, along with Tracy Reinick, stock analyst for Zacks.com, and our top market technician, Kevin Matris, all here at the round table. So we had a little bit worse than expected news back last Thursday. We're at the 6th of July right now, and so before we broke for the long 4th of July weekend, we saw that employers apparently trimmed a few more jobs from their payrolls in the month of June than was expected.
Yeah, well, actually, we take a step back. On Wednesday, there was three different jobs reports. You could call it kind of, if this was a fight, right, if this was a match night, this would be like the undercard was on Wednesday. And actually, when people took a look at that news, it was considered to be relatively favorable. And the market rallied on Wednesday, and people felt fairly good about that. I think it was mostly the Challenger report about the announced layoff. Those numbers looked very good as compared to consensus. But then we got the heavyweight match. We got the prize fight on Thursday, right. And that was the June jobs report, and it was terrible. Okay, came out 100,000 jobs more were lost than what was expected. Okay, and so all this green shoot sightings kind of went out the window, and it was no matter how you looked at that report, it was negative. The market took 2.7, 2.9% tumble. We have some echoes of that today, as the market, I think when we got here, was down about 1%. So obviously, very bad news for the job market. And I think what people are starting to realize is the idea is this idea of bottoming and then recovery. The thing is, we can stay at bottom for a long time. And I think that's what investors started to realize a bit on Thursday, and that's why we got the reaction we did.
Kind of what we talked about at the last roundtable, where this sideways market movement can go for a long time in a secular bear market.
Yeah.
So what we've got, Tracy, is nearly 3.4 million jobs lost during the first half of 2009. Economists, though, still trying to put a good face on this one, saying, when there's an economic recovery, in fact, the unemployment rate can go up.
Yes, it can, but we're not really seeing that here, I don't think. I think there's been a couple warning shots across the bow in the last couple of weeks from big companies that the market's kind of not paying attention to. General Electric a couple of weeks ago, the head of their industrial division, said that they aren't seeing any change in their orders whatsoever, and they don't see it for the second half of the year. Well, if the big industrial companies aren't seeing it, they're a smaller percentage of our economy now, but who is? And then over the weekend, the president of Eaton Corporation said in Business Week that they're not seeing any bottom. They don't believe this is the bottom. They're big in hydraulics and aerospace. They do business in 150 countries, and they're not seeing any change until at least 2010. They did say that they see some stabilization maybe in the fourth quarter, but that's a lot different than what everyone's been hoping for with this whole second half recovery. These big companies aren't saying that the second half recovery is going to be there. And up until last week, the market's been just not paying attention to anything that they're having to say. And now, maybe they're going to sit up and take notice after we had these job numbers, and more of these companies are coming up with earnings season starting.
What do you think of these job numbers, Kevin? Economists out there saying even though the unemployment rate, now 9.5%, hit another 26-week high, it only went up 0.25% from the previous month.
Right.
That's not so bad. It was at 9.4 the previous month. That's not so bad.
I think unemployment is at a 26-year high.
26, yeah.
Yeah, it's pretty brutal out there. What's interesting is that everybody talks about unemployment as a lagging indicator.
Right.
And it is in a sense, but with jobless claims on the rise, it's very real. It's very right now. And until we can see jobless claims start to go back down on a period-by-period basis, start to see jobless claims start to trend lower, right? Then people are going to finally be able to put unemployment in the rear view mirror context where it belongs. The problem that we have right now, though, is that, I think the government significantly underestimated the amount of unemployment we were going to see. I saw Joe Biden on TV over the weekend. He said that that they got it wrong. He says they were looking for 8% or 9%. Here we are, unemployment's at 9.5%, and those are, I mean, it's getting perilously close to the worst case scenario unemployment numbers that they were using for the bank stress tests.
Right.
So, you know, who knows when this cycle of unemployment is going to be broken? But I do believe everybody is really going to be paying attention to the jobless claims. What was so disconcerting, though, is that the jobless claims were coming from all of the wrong areas. Even government, you can usually count on the government to hire about 20,000 workers each period, and even they fell short. So you're looking at manufacturing slowing down, you're looking at transportation slowing down, you're looking at all of these very important critical elements to our economy slowing down, and I think it really spooked a lot of people.
So what does it mean for the stock market, Tracy? Is the market headed for stagnation? That's the big concern now.
I think a lot will depend, as I said earlier, on the earnings reports. And, you know, I was in some stores over the weekend because this was the weekend that they were trying to clear out, at least in apparel, and actually a lot of other items, all of their summer merchandise. So It's like 50, 60, 70, I saw even 80 or 90% off, and no one was in those stores here in the Chicago area. So they're getting their fall merchandise in next week, so I just don't think that bodes well for the big retail sector and a couple of the other sectors that we're going to see now. And we've seen a little bit with the restaurants that have already reported in the last couple of weeks. Their numbers this last quarter were, in some cases, worse than the first quarter. So especially on like the upper end. And then we had like Saks Fifth Avenue saying they're cutting their inventory 20% going forward, and that includes the holiday season just to try to pare down the inventory. Yep. So I don't know. I mean, we'll see what happens with the earnings and what comes in. But, you know, a lot of these things are kind of going against keeping even the trend line here, but it's hard to say.
What do you think of that stagnation concept, Kevin?
I don't know. It is interesting, though, that here you have restaurants who are doing great. You can take a look at chart after chart. You see a lot of restaurants trending higher. So I think a lot of people are you know, trying to maybe relieve the misery that they're going through by buying some additional clothes, cheap clothes, going out to restaurants, not your McDonald's, but I mean something that's a sit-down restaurant, and kind of, you know, put yourself in a better state. The reason why this unemployment, though, is just such a big deal is because it's been said over and over before that 70% of our economy is tied to the consumer. So if the consumers are spending less money, that means companies are making less money. If they're making less money, they're laying more people off. If they're laying more people off, now you have less people working. And the less people that are working, there's less money going into the economy. So eventually this whole cycle is going to get itself, you know, worked out. But at the moment, it's something that everybody is very, very concerned about. There are areas of bright spots, though. Mm-hmm. You know, the stimulus package, everybody was wringing their hands over it when it was first passed. They did say it was going to create a lot of jobs, or at least save a lot of jobs. But up to this date, only a very small portion of the stimulus package has actually worked itself into the economy. And some of the most non-stimulative aspects have been put into place at the beginning. So the stimulative aspects are coming down the pike in the end of the second quarter, third quarter. That is probably going to help the manufacturing sector. But there still are bright spots, too. Healthcare added jobs in the most recent jobs report. Education, they were looking at jobs. And then we have this cap and trade. Who knows how that's going to go, but there's going to be all of this push towards energy and clean energy and the electrical grid and all of this stuff. So there will be areas of bright spots, but everybody is just wondering, when is it finally going to come?
So can we be looking at the concept of a stock market recovery totally disconnected from an economic recovery this time around?
At the end of the day, they have to meet up together. Okay, so yes, the stock market can predict ahead of time what the economy is going to do, and but at the end of the day, it needs confirmation, or else we'll fall apart. Today's been a pretty dour, conversation. For me, and it's kind of been a repeat of what I've said in the past. Just because things are getting less worse doesn't mean they're getting better. Mm-hmm. So in my book, it's this: how long do we drag along bottom? Dragging along bottom, meaning in the economy, is not a reason for the market to retest 6,500. So it's not like, oh, goodness, we're going to head back down there. but it's a reason for pause. It's a reason to say how much higher can we go if there's not really signs of improvement out there. And so that's why we continue to be in this trading range, 8,000 to 8,800. And I expect to stay in that range until there's a little more confirmation from the economy, a little more confirmation from corporate earnings. We'll see what happens with the earnings reports that start up this week. From Alcoa is getting kicked off this week. But I'll say real quickly, we talk here about the earnings pre-announcement season, which is just before earnings start when the companies with the bad numbers report. I got to say it's been very quiet on that front, which may be a good story. I'm not saying it means gangbuster earnings. I'm just saying nobody's coming clean and saying, oh, our numbers are terrible. You know, the pre-announcements, they adjust their earnings, their estimates before the actual earnings come out. Very quiet on that front, and that may be a good story for us.
Well, the Cubs were finally sold anyway, so maybe that'll help add some jobs back into the Chicago economy.
Well, there's only 25 jobs on that team, so good luck with that, Terry.
That's the latest thinking here at the Roundtable as far as the markets and the economy are concerned in light of the latest jobs data. Don't forget, you can go to Zacks.com's homepage and get a lot more in the way of macro commentary and individual stock pick ideas as well. www.zacks.com. You want to keep that bookmarked for yourself. With everyone here, I'm Terry Ruffalo.